Welcome back to the Deep Dive. Our mission here is pretty simple. We take that whole complex stack of reports, the dense financial filings, the raging market debates, and we just distill it down so you can grasp the full picture.
And today we are diving into a company that has really been the poster child for this whole AI disruption narrative.
Of the last year, yeah?
Absolutely. And yet, at the same time, it remains this absolute titan of software and creativity, Adobe.
It's just the perfect investment puzzle right now, isn't it? The market has, well, it's been treating Adobe like it's this aging giant that's, facing its inevitable end.
And that's led to just massive stock volatility. But when you strip away that narrative and you actually look at the financials, you look at their strategic execution, you see a business that isn't just surviving, it's aggressively transforming.
And that gap, between the perception and the reality, it got so wide that some of the most disciplined investors on the entire planet started to notice.
And that's where we have to start.
Exactly. That's our jumping off point for this deep dive. We're not starting with an earnings report. We're starting with this massive signal of conviction from, well, one of the most consequential institutional investors in the world, Ray Dalio's Bridgewater Associates.
For anyone who tracks the macro world, Bridgewater is. It's just known for this incredibly rigorous, principles-driven approach. They don't follow the hype. They follow fundamental analysis.
And when Bridgewater moves capital, especially at this kind of scale, you have to pay attention.
You really do. Their latest filing from September 30th, 2025, it revealed a genuinely stunning move, a colossal increase in their stake in Adobe.
They didn't just add a little bit.
No, they didn't just nibble. They increased their holding by a staggering 73.09%.
Wow. 73%. That's conviction.
It's huge. That move immediately valued their stake at over $445 million, and it rocketed Adobe into their top 8 individual stock holdings.
Which, for a firm like Bridgewater, that's famous for diversification, for these huge macro bets. Putting 1.74% of their entire equity portfolio into a single stock like this is a very, very strong directional bet.
And here's the context that makes the move even louder. You have to look at what they were doing elsewhere.
Right.
Bridgewater was not uniformly bullish on big tech in that very same period. They were strategically slashing their positions in other mega-cap tech giants.
The ones you'd think of as the obvious AI winners.
The obvious ones. Names like NVIDIA, Alphabet, Microsoft, they were trimming those.
So, just to get this straight, they're selling the companies that literally make the AI chips and run the AI clouds. And instead, they're placing this near $500 million bet on the one company whose core business creative software is supposedly the most vulnerable to being disrupted by AI.
It's an incredibly powerful signal. It suggests Bridgewater thinks the market fear around Adobe is just deeply misplaced.
They see something everyone else is missing.
I think so. They're expressing a strong belief in the durability of this enterprise software and creative workflow segment. The thesis seems to be that Adobe will be a winner in this AI transition, not a casualty.
Okay, that sets our mission for today perfectly. Why are these strategic giants betting so big on Adobe right now? We're going to unpack the company's financial engine, we'll dissect its legendary competitive moats, and then we'll drill right into that central debate. Is this a story of fatal AI disruption, or is it a story of massive AI monetization?
And I think we have to start with the bedrock, the foundation that lets them weather any kind of storm or, any technological shift. Their financials.
So yeah, let's get into the numbers.
Yeah.
So when we look at Adobe's financial structure, you have to acknowledge that critical decision they made, over a decade ago?
Oh, absolutely. Moving away from selling software licenses in a box.
Yeah, the old model.
To a cloud-first, subscription-based model. It wasn't just a billing change. It was a fundamental shift in the entire business.
It was painful for them at the time, right? The market hated it initially.
It was very painful. But it's now totally complete, and the rewards are just crystal clear. Over 95% of Adobe's revenue is now recurring subscription revenue.
And that's the holy grail for investors like Bridgewater.
It is the single most important metric. It just eliminates the volatility of those old boom and bust product cycles. You get highly predictable, reliable cash flows, and that anchors the entire valuation.
So let's break that down. Where does all this recurring revenue actually come from?
Well, it's really built on 3 pillars, but, 2 of them do all the heavy lifting. The primary engine, the core that everyone knows, is digital media.
Right.
That's about 74% of total revenue. It's the content creation powerhouse.
And that's split in two parts, right?
Exactly. You've got Creative Cloud, that's your Photoshop, Illustrator, Premiere Pro, and then you have Document Cloud, which is Acrobat and Adobe Sign.
Okay, so that digital media segment, that's ground zero for this whole AI battle.
It is. That's where the most immediate Gen AI substitutes are popping up. But then you have the second big pillar, the one aimed at large corporations.
And that would be?
Digital experience, or DX. That brings in about 25% of the revenue. This is their big enterprise, B2B play. Think marketing automation, digital analytics, customer journey management.
So they're going head-to-head with some huge software companies there.
Huge. And then, a tiny fraction, about 1%, comes from publishing and advertising, which is mostly legacy products.
So if we look at their most recent performance, Q3 of fiscal year 25, the numbers seem to tell a story that's very different from the market narrative of a collapsing business.
Not collapsing at all. They delivered record revenue, $5.99 billion for the quarter. That's 11% year-over-year growth. For a business this big, that's very steady double-digit growth.
But I think you'd argue the more important number isn't the revenue today, it's the revenue they've already booked for tomorrow.
That's where the remaining performance obligations, the RPO, comes in. And this is so critical.
Explain that for us. RPO is basically their future revenue backlog.
That's a perfect way to put it. It's contracted revenue that they are obligated to deliver. It's the ultimate measure of future visibility and stickiness. And their RPO just surpassed $20 billion.
$20 billion.
It exited the quarter at $20.44 billion, which is 13% year-over-year growth. For a software company, that huge backlog, it just minimizes all the short-term noise. It means big enterprise customers are still signing multi-year deals.
So that revenue stream is locked in for years, regardless of what the stock market does next week.
That's the stability Bridgewater loves. And if you drill down into the segments, that health continues. The digital media recurring revenue, or ARR, exited at $18.59 billion, growing at almost 12%. The engine is still humming.
Okay, so the operational reality is one of stable double-digit growth, but we have to address the financial elephant in the room, the thing that can distort the true profitability picture for these big tech companies.
The GAAP versus non-GAAP divide.
Exactly. This is where you have to do your homework and look past the headline numbers.
It's a crucial point. In Q3, Adobe reported GAAP earnings per share of $4.18. But the number they highlighted was their non-GAAP EPS of $5.31.
That's a huge gap, a 27% difference. What's driving that?
Well, the primary driver, the adjustment that executives love to ignore, is stock-based compensation, SBC.
And this brings us right back to that classic, timeless wisdom from Warren Buffett.
It does. Buffett's logic is just so simple and powerful. If you pay an employee, whether it's in cash or in stock, it's a form of compensation. And compensation is an expense, period. It reduces the value available to shareholders.
You have to treat it as a real expense, because if you don't buy back stock to offset it, every single shareholder gets diluted, their piece of the pie gets smaller.
And at Adobe, the scale of this is really significant. SBC and related expenses were $521 million in Q3 alone.
Just in one quarter.
In one quarter. To put that in perspective, that's nearly 20% of their recent free cash flow. Now, it's standard practice in Silicon Valley to use stock to attract talent, but the sheer amount here is something that requires serious scrutiny.
Especially for a company this mature and profitable.
Right. It creates the structural headwind. The company is constantly spending billions on buybacks just to keep the share count from exploding. It's a real recurring cost of doing business.
But even after you account for that, their underlying profitability is still pretty exceptional.
It is. Their GAAP operating margins are still incredibly high, which really speaks to their pricing power and their competitive position.
Which brings us perfectly to part two, the foundation of that pricing power, their competitive moat.
In the software world, a moat is all about how defensible your business is. And for Adobe, it's not really about patents. It's about deep, entrenched user habits.
It's all about switching costs, right?
The switching costs here are, I would argue, they're among the strongest in the entire tech sector. For a professional creative, a designer, a video editor, the cost of leaving Adobe is just astronomical. And it's not just the subscription fee.
So walk us through that. Why can't a big company just say, okay, everyone, we're switching to this cheaper competitor on Monday?
Because of the ecosystem. It's all built on these proprietary HILE standards that have existed for decades. Every PSD file from Photoshop, every AI file from Illustrator, even PDFs. These are assets that are most reliably and sometimes only fully editable within the Adobe suite.
So if a company tried to switch, they'd have this massive legacy problem.
A massive problem. Migrating old files, ensuring compatibility, and then the most expensive part. Retraining thousands of employees on a completely new, complex interface.
It's that human capital, the skills people have spent years or even decades building in Photoshop. They're not easily transferable.
Exactly. The learning curve is immense. And the skills are transferable between Adobe products, which just reinforces the lock-in. You learn the Adobe way, and you can jump from Premiere Pro for video to After Effects for motion graphics seamlessly.
That efficiency is what a professional studio lives and dies by.
And it creates an almost impenetrable barrier. And then on top of that, you have the brand.
Oh yeah, the brand itself is a huge asset.
It is. Photoshop isn't a product anymore, it's a verb. It's the global synonym for image editing.
Right, like to Google something.
Exactly like that. And that brand recognition translates directly into pricing power. When a client demands industry standard files, they're implicitly demanding Adobe. That's why they can maintain gross margins that are consistently north 85%.
And to keep that leadership position, they have to outspend everyone else.
Which is their second major moat, R&D scale. Adobe is investing about $4.2 billion a year. That's 18% of their revenue back into product development.
A startup just can't compete with that kind of budget.
They can't. A startup might innovate on one cool feature, but they can't sustain that level of comprehensive cross-platform spending year after year.
Let's talk about the Document Cloud for a second. Creative Cloud gets all the attention, but Document Cloud seems like this incredibly stable, quiet workhorse.
It's a masterpiece of sticky software. It benefits from the fact that Adobe literally created and has controlled the PDF standard for 30 years.
So in any regulated environment, legal, finance, government, where document integrity is non-negotiable.
They're the standard. Digital signatures with Adobe Sign, compliance, making sure a document is tamper-proof. The PDF is it. And that makes Document Cloud incredibly resilient to disruption. In fact, it's their fastest growing segment right now.
It was fascinating. Okay, so that brings us back to the enterprise side, to digital experience. They're up against giants there, but they have a unique advantage.
They do. They're competing with Salesforce, Oracle, SAP. But Adobe's unique play is what we call the creative to marketing workflow.
How does that actually work in practice?
So most competitors just focus on the marketing execution, the analytics, the campaign deployment. Adobe starts at the source. A big company needs thousands of personalized images and videos for a campaign. With Adobe, they create that content in Creative Cloud, manage it all, and then push it directly into the Experience Cloud for personalization and deployment.
So it's a unified content supply chain.
No one else offers that. It links the creator directly to the marketer. It means faster speed to market and guaranteed brand consistency, which is priceless for a Fortune 500 company.
Okay, so we have this clear picture. Strong financials, sticky subscriptions, powerful competitive moats. And yet, the stock has been trading like the business is fundamentally broken, which brings us to the core conflict, the very thing Bridgewater is betting against.
The AI overhang, the market volatility, the stock being down 36% over the past year, it's purely about AI. Investors are terrified of the innovator's dilemma.
The fear is simple, right? Why pay hundreds of dollars for the full Photoshop suite if a simple, cheap AI tool can get you 90% of the way there in a fraction of the time?
That's the fear, that this commoditization will push their growth below 10%, that their pricing power will erode, and that fear is fueled by some very real competitors.
So let's name them. Who are the primary disruptive forces here?
First, from the bottom, you have Canva. Canva is aimed at the prosumer, the small business owner. It's all about simple, template-based tools with basically zero learning curve.
They democratized design for the masses.
They did. And while they don't threaten a high-end professional studio, they absolutely cut off Adobe's entry point for millions of new users.
And then there's the pressure on the more modern collaborative design workflows.
And that's where Figma sits. Figma is king in collaborative design, especially for product teams building apps and websites. Adobe's failed $20 billion attempt to buy them really put a spotlight on this vulnerability.
And finally, you have the pure AI native startups.
Yeah, the generative engines. Midjourney, Stable Diffusion, Runway ML. These platforms just bypass traditional workflows entirely. They show that the fundamental process of creating can be radically simplified.
This all brings to mind that classic analogy from Charlie Munger, the Munger Loom story. It just perfectly captures the anxiety here.
It's such an essential framework. Munger tells the story of a textile mill owner who tells Warren Buffett a new loom has been invented that can double the mill's productivity.
And Buffett's reaction wasn't excitement, it was dread.
Exactly. He said, "Gee, I hope it doesn't work because if it does, I'm going to close the mill." And the brutal logic is this. If that super efficient loom is available to everyone, then everyone has to buy it to stay competitive.
Right.
The whole industry invests billions, but since everyone is now more efficient, supply goes up, competition drives prices down, and all the benefit goes to the consumer, the producer's profit margins get crushed.
And the fear for Adobe is precisely that. If their Firefly AI makes their users twice as productive, but a similar AI is available everywhere for cheap, do they just end up commoditizing their own value proposition?
That is the bear case, perfectly articulated. But the bull case, what Bridgewater is clearly betting on, is that Adobe has found a way to turn that analogy on its head. They're turning AI from a threat into a proprietary monetized feature that actually strengthens their moat.
So let's pivot to the bull case. The key metric that proves this is working is the AI-influenced ARR.
This figure is the core success story. Adobe is reporting that their AI-influenced annual recurring revenue has now surpassed $5 billion. That's up from $3.5 billion just a year ago.
So what does that actually mean?
It means that AI features are directly responsible for either generating new subscriptions or retaining existing ones. It's not a hypothetical, it's demonstrable customer willingness to pay for AI.
And this is on top of the brand new AI products themselves.
Right. The ARR from their new AI-first products, like the Acrobat AI Assistant in Gen Studio, has already blown past their year-end target of $250 million. The adoption is happening fast.
I think the cornerstone of this bull case, especially for their big corporate clients, has to be the Firefly strategy. It's all about being commercially safe.
This is the absolute linchpin. Firefly, their generative AI, is trained exclusively on legally licensed content from Adobe stock or public domain content. This clean data set is a world away from open source models that just scrape the whole internet, including copyrighted material.
And why does that matter so much to a Fortune 500 company?
2 words. IP Indemnification. This is the commercial seal of approval. Adobe guarantees legal protection for its enterprise customers.
So if a company gets sued for copyright infringement over an image their AI generated for a big campaign,
Adobe takes the hit. They absorb the costs, the legal defense, the liability. That guarantee is invaluable. No major corporation can risk a multi-million-dollar campaign getting derailed by a copyright lawsuit from a cheap, legally dubious AI tool.
the legal risk far outweighs the cost savings.
Infinitely. Adobe transforms from just a software provider into a strategic risk mitigating partner. That is a moat that the high-end market will always pay a premium for.
And they're not even forcing customers to use only Firefly, which is a really smart move.
It's a genius platform approach. They realize different AI models have different styles, so they're integrating their own models alongside leading third-party models, Google's, OpenAI's, and others, directly into their apps.
So you never have to leave Photoshop.
You never leave the ecosystem. Adobe remains the operating system for creative work. No matter which AI engine you want to use, it just strengthens the lock-in.
Let's look at how this is actually playing out in the products, starting with Creative Cloud.
In Creative, AI is driving real productivity gains that justify upgrading. A new feature like Harmonize in Photoshop. It uses AI to automatically blend the lighting and shadows between different objects you composite together.
A task that used to take a skilled artist hours of painstaking work.
Hours! Now it's instant. And that's what's driving adoption of their higher-tier Creative Cloud Pro offering. People will pay more for tools that save them that much time.
And the impact on Document Cloud seems just as transformative. It's not just about static PDFs anymore.
Not at all. It's becoming a knowledge hub. The Acrobat AI Assistant can have a conversation with you about a 500-page legal contract or a year's worth of reports. It can summarize them, find key insights. That assistant saw its usage grow over 40% in a single quarter. The demand is intense.
And then there's the big enterprise play, Gen Studio.
That's where AI truly scales for them. Gen Studio is this comprehensive content supply chain solution for big companies. It's already a huge business driver. The components within it now exceed $1 billion in ARR, and it's growing over 25% a year.
So if all this operational evidence is so strong, double-digit growth, proven AI monetization, a defensible legal moat. Why on earth is the stock trading at such pessimistic levels?
And that brings us right back to the valuation disconnect. This is the core of the Bridgewater thesis.
The stock is trading like an AI loser when the company's executing like an AI winner.
Exactly. Despite these incredibly robust fundamentals, 10% growth, 40% plus EBITDA margins, the market has just slapped this huge discount on the stock out of fear.
The multiples are just shocking, really.
They are. The trailing price-to-earnings ratio is around 21. The price-to-free cash flow is around 15. For context, this company has historically traded at an average PE of 48.
So it's trading near its lowest valuation since 2012.
Before the subscription model even really took off, a PE of 21 for a software leader like this is typically reserved for, a slow-growth industrial company. It's pricing in zero growth or worse.
So if those AI fears just fade a little bit and the multiple goes back to, say, 35, that implies massive upside potential.
That's the multiple expansion opportunity. And the company itself is taking advantage of this low price with a huge share buyback program.
Right. They bought back 8 million shares in just the last quarter. How significant is that?
It's extremely significant. It functions as a tax-efficient return of capital to shareholders. They still have over $8 billion left on a massive $25 billion authorization.
By shrinking the number of shares, they're directly boosting the earnings per share.
And it gives you an amazing shareholder yield. Recently, it's been around 8%. An 8% yield on a high-quality tech stock is highly attractive. It's a huge signal for management that they believe their own stock is the best investment they can make right now.
So when you look at Wall Street analysts, they seem to agree.
Overwhelmingly bullish. Price targets range from $450 to over $586, suggesting upside of 25 to 42% from these levels.
Now, we should be clear, the hypergrowth days of 15% plus revenue growth are probably over.
That's fair. Revenue growth is expected to settle in that 8 to 10% range. But, and this is key, EPS growth is projected to be higher in the 11 to 14% range.
Because of operating leverage and those massive buybacks.
Precisely.
So the thesis is you're buying a premium, high-margin software company with incredible moats that is successfully monetizing the very technology that was supposed to kill it, and you're getting it at a distressed price.
That's the thesis in a nutshell. Bridgewater is betting the market's psychological fear is just overshooting the fundamental reality.
So this deep dive started with Bridgewater's contrarian bet, and I think our analysis really confirms why a firm like that would see deep value here. Adobe is fighting this crucial two-front war.
On one front, they're defending the high-end, the professionals, and the enterprises by leveraging their workflow and that commercially safe AI. With Firefly, that's what keeps their core high-margin customers loyal.
And on the other front, they're battling that bottom-up threat from Canva and Figma by making their own tools simpler and just continuing to strengthen the stickiness of the PDF standard. The numbers show it's working.
So the ultimate question, the trade-off for you, the learner, is this. Can Adobe's structural moats, the switching costs, the IP indemnification, can they continue to repel the commoditization pressure from these cheap AI-native tools?
The evidence says yes, but the market hasn't given them credit for it yet.
Not yet.
Which brings us to our final provocative thought. We've established the stock is cheap because of fears about future growth. Given Adobe's massive free cash flow and the market's pessimism, consider this. What if they took a page from Meta's playbook? What if they pivoted their capital allocation strategy away from just buybacks and initiated a meaningful growing dividend?
Wow. That's a fascinating idea. A shift like that would be a huge signal.
It would be a huge signal of confidence in their long-term stability, wouldn't it? It would force investors to see them not just as a tech company in transition, but as a mature, durable, quality income-generating machine.
That pivot could fundamentally reset the entire narrative and the valuation multiple far faster than any single earnings report ever could.
A fascinating possibility to think about. We'll leave you with that. Until next time, happy deep diving.